Did you know that most traders use Bollinger Bands wrong and it's costing them money? If you've ever struggled with false signals or unpredictable price movements, you're not alone. In this video, I'll show you how this really works and the secrets behind it. Then, I'm going to teach you a high probability trading setup that you can take with confidence. Unlike other indicators that only focus on price movement, Bollinger Bands adapt dynamically to market conditions. By analyzing the relationship between price and Bollinger Bands, you can gauge whether the market is trending or ranging, as well as anticipate profitable breakouts. Now let's break down the key concepts of the Bollinger Bands indicator. This indicator is pretty simple at its core. It's made up of three main parts. First, and most importantly, the middle line, a 20-period simple moving average or SMA, representing the market's overall direction. If the line is trending upward, the market is in an uptrend. And if the line is moving downward, the market is typically in a downtrend. It really can be that easy. Next, we have the upper and lower bands. The upper band is calculated by adding 2 standard deviations to the middle line. On the other side, the lower band is made by simply subtracting 2 standard deviations to the middle line. These bands are a great measure of market volatility. When they begin to contract, the market is in a low volatility period, also known as consolidating or ranging. When the bands begin to expand and move away from the middle line, the market is entering a high volatility period, meaning it's trending and moving with heavy momentum towards one side of the market. Now there's a lot of ways that people use this wrong, and one of them is by using the Bollinger Bands to figure out when an asset is overbought or oversold. When price touches or moves outside the upper band, it could be considered overbought and could suggest that a potential short opportunity may be on the horizon. Similarly, if price touches and falls below the lower band, the asset may be oversold, indicating a potential buying opportunity. Now, taking trades just based on this is actually not a good idea. Let me explain. Let's say the middle line is moving upward, so we have some evidence of an uptrend. If price breaks above the upper band, it begins to suggest that it's overbought, and you would then look to short the asset. But as time passes, this often happens. The market eventually moves up higher and you end up taking an unnecessary loss. This happens because using the Bollinger Bands as an overbought or oversold indicator means you're trading against the trend, and this is not ideal. Now, after using this indicator for many years, I found a highly effective strategy that actually works. The strategy is called the Bollinger Band squeeze, and this is what it looks like. When volatility is low in the market, the upper and lower band begin to squeeze and they become narrow. This foreshadows a significant advance or decline in price movement. You definitely want to combine the Bollinger Bands together with other indicators. One indicator, though, that's commonly used and has some great synergy is the Bollinger Band bandwidth, or the BBW, which is basically just an indicator to measure the distance between the upper and lower band. This indicator is the value of the upper band minus the lower band. When volatility decreases, the BBW will have a low reading or value, and it will rise as volatility begins to increase. Whenever this squeeze happens, a breakout is likely to occur. So we must prepare and be ready to trade the breakout. For that, we're going to use one more indicator, on balance volume, or OBV. The main use of this indicator is to help us spot a divergence, which will help us with confluence and supporting evidence and give us an idea of how to determine the direction of the breakout. By the way, all these indicators are free and you can find them on tradingview.com. This might be a lot to take in at one time, so let's put all these concepts together and see how they really work out in a trade. Over here, we can see a flat moving average. The bands are contracting, and that's indicating we're in probably a sideways market here. This can also be seen by a low reading on our BBW. Here, the price traded to the lower bands and it created a lower low. But if we take a look at our OBV, we can see that we got a clear bullish divergence. the OBV has made a higher low, while price has made a lower low. This is the first clue to the direction of the breakout. Next, we see the bands are beginning to expand, and this can also be seen by the rising BBW. This is then followed up by a green bullish candle that's closed above the upper band. With all these factors in place, the market is looking to expand higher. We can look to combine this with other tools such as horizontal support and resistance, Fibonacci, etc. to help us enter a long trade. But here we have an old resistance level that price has broken through recently. Because of that, this has turned into a support level, and price will likely look to sweep this liquidity or retest it. This could be a great area to look for an entry for a long. As always, aim for a favorable risk to reward ratio and be mindful of where you place your take profits and stop loss. If you found this video helpful, I ask that you share it with another trader that might get some value too. This playlist is free, and if you haven't checked it out yet, there are dozens of videos on all of the topics that you need to know about to be a successful trader. And make sure to subscribe and smash the like button for more. Also, leave a comment. Let us know what topics you'd like to see next.